Today we're embarking on a really fascinating journey into the world of corporate fraud detection. It can seem a bit murky sometimes.
Definitely.
We're going to get a shortcut, really, to being well-informed on a critical paper. Who blows the whistle on corporate fraud? Yep. That's by DYCK, MORSE, and ZINGALES from the Journal of Finance back in 2010.
Yeah, and this isn't just any old paper, right? It's really a seminal piece in corporate governance. And the timing was crucial. It came out right after those massive frauds, Enron, WorldCom.
Right, the ones that led to Sarbanes-Oxley.
Exactly. SOX. So our mission here is to unpack this really foundational research. We'll use 6 structured questions to guide us. We want to help you understand not just what they found, but how they actually built the study, the mechanics of it, and what it all really means.
Okay, sounds good. Let's kick off with that first question then. What exactly were DYCK, MORSE, and ZINGALES trying to figure out? What was the core research question, and why was it so important at that particular moment?
Well, they set out to answer some really pressing questions that were just hanging in the air after those scandals, basically. Who are the people or groups actually bringing corporate fraud into the open? Like, for real?
Not just theoretically, but in practice.
In practice. And what motivates them? Why stick your neck out? Also, did the reforms that came after SOX, which were supposed to fix the system, did they even target the right players? Did they actually change anything?
And could we do it better, more cost-effectively?
Precisely. Can fraud detection be improved without, breaking the bank?
And its importance? Well, it's huge. Lawmakers passed SOX largely assuming the existing institutions' auditors, regulators had failed. But that assumption wasn't really based on solid empirical evidence.
More of a reaction to the crisis.
Kind of, yeah. This paper provides that empirical foundation. They looked at 216 alleged corporate fraud cases, big ones, large U.S. companies, over $750 million in assets between 1996 and 2004. So these weren't small potatoes. They include those big headline-grabbing frauds you definitely remember. Okay, so that sets the stage. Now, before they jumped into their own data, what existing theories or frameworks were they sort of testing against? What were the prevailing ideas about who should be the main fraud detectors?
Right. So they outlined 3 main traditional views. First, there's what you might call the legal view. This idea is pretty straightforward. Auditors and securities regulators, like the SEC, should be the primary detectors. Why? Because they're legally mandated to promote disclosure and protect investors from fraud. It's their job description, basically.
Makes sense.
Second, there was the private litigation view. This was championed by scholars like Coffey. The thinking here is that private lawyers, especially in class action lawsuits, have a really strong incentive money. They work on contingency fees, so exposing a big fraud means a big potential payday.
All the money?
Exactly. And third, you have the financial risk view. This draws on Fama's work. It argues that monitoring really falls to those with the most skin in the game. So equity holders, debt holders, and the people working for them, like analysts, auditors again, rating agencies, people whose investments are directly at risk.
And under this view, employees or suppliers wouldn't really be expected to monitor much.
Generally, no. Their contracts are usually more fixed payoff, unless, maybe, employees have significant stock options that align their interest more with the shareholders. But traditionally, they weren't seen as key monitors in this framework.
Okay, so those are the established views. But it sounds like the authors felt something was missing, right? What were these other factors they thought might be playing a really crucial role?
Yes, exactly. This is where it gets really interesting. They proposed several sort of missing factors that the traditional views didn't fully account for. One was monetary incentives beyond just owning stock or debt. Think about qui tam laws.
Ah, the whistleblower reward statutes.
Right, especially in healthcare fraud against the government. An employee, say, who blows the whistle can get a pretty hefty percentage, like 15% to 30% of whatever the government recovers. That's a massive incentive. And of course, short sellers benefit directly when bad news hits a stock price.
Okay, so direct financial
Welcome to the
rewards,
Lion's
not
Share
just
podcast,
investment risk. What
where
else?
we break down today's
Second,
most
career
impactful
concerns.
research and bring
Or
fresh insights from the academic
reputational
frontier
incentives, you could
straight
say.
to you.
Uncovering a major fraud could be a big career booster for a journalist or maybe an analyst. Even regulators or auditors, potentially leading to better jobs or promotions. Though they also noted there are potential downsides, reputational costs, too.
Sure, you might get labeled a troublemaker.
Could be. And the third factor, which I find particularly insightful, draws on Hayek. the cost of accessing information. Hayek argued information is spread out, it's diffuse. Some people, just by doing their regular jobs, employees, industry regulators, maybe analysts covering a sector, stumble upon relevant information. Their cost of discovery is way lower than someone like a short seller who has to actively dig from the outside.
So proximity matters. Employees just see things sometimes.
Exactly. It's a byproduct of their daily work. That's a potential advantage the traditional views often overlooked.
Okay, this is fascinating. Now let's get into the nuts and bolts. For our listeners deep into research methods, this next part is crucial. How did DYCK, MORSE, and ZINGALES actually do this research? What was their methodology, and how did they ensure their findings were, valid and reliable? Tackling validity here seems really challenging.
It absolutely is, and their approach was remarkably thorough. They started by identifying potential fraud cases from the Stanford Securities Class Action Clearinghouse, a standard source for large U.S. firms between 1996 and 2004. But they didn't just take every lawsuit.
No, they needed to filter out the noise.
Precisely. To ensure construct validity, making sure they were actually measuring real significant fraud, they applied 6 pretty rigorous filters. Things like the case had to be filed after the 1995 Litigation Reform Act. The firm needed over $750 million in assets. The case couldn't be dismissed by a judge. The settlement had to be at least $3 million.
So filtering out smaller or less substantiated claims.
Exactly. And they excluded certain types of fraud, like pure stock manipulation. This meticulous screening took them from 2,171 initial suits down to their final sample of 216 frauds. It shows a huge commitment to getting a clean, relevant data set.
That's a massive reduction.
Yeah.
But filtering so heavily, does that risk maybe missing certain types of fraud or detection mechanisms that just don't make that high bar?
That's a fair question. It's always a trade-off in empirical work, isn't it? They were very clear they wanted to focus on material frauds in large public companies where detection mechanisms might be most visible and the impact most significant. They weren't claiming to capture every instance of wrongdoing, but rather the detection of major, publicly exposed frauds. Identifying the initial detector was absolutely central.
How did they pin that down? That seems like it could be subjective.
It could be, and they worked hard to address that for internal validity. First, just sheer data collection. They read, on average, 800 Factiva news articles per case. 800. Plus legal documents. All to painstakingly reconstruct the timeline and identify who first brought the issue to public light. Imagine the reading load.
Wow. Okay, so deep dives into the history of each case.
Deep dives, exactly. Then the coding process itself was rigorous. Initial coding was done by a research assistant and at least one author, but then all 3 authors had to reach a consensus on any ambiguous cases. And get this, a year later, they recoded the cases independently to check consistency. That's serious dedication to reliability.
That's impressive. Double-checking their own work a year later.
Yeah. And they even created a smoking gun indicator for cases where they felt most confident about who the initial detector was. They reran analyses using only those cases, and the results held up, which helps address concerns about subjectivity.
Any other checks?
Yes, they used event studies. They looked at the stock price movement right around the date they identified as the whistleblowing event. They found, on average, a 20% negative abnormal return in the 2 days surrounding the event.
Which confirms the news was significant, and they likely got the timing right.
Exactly. It confirms the materiality and the timing. And one more clever thing, they knew short sellers often try to stay anonymous, so they used an econometric trick. If a firm's short interest was abnormally high, like 3 standard deviations higher than usual in the months before the fraud revelation, they'd reclassify the whistleblower as potentially being a short seller, or at least driven by short seller information.
That's smart, trying to uncover the hidden actors.
Yeah.
Now, what about external validity and potential selection bias? They focused on discovered frauds, right? What does that mean for generalizing the findings?
Right. That's a really important boundary they drew. They are very upfront that their study is about detected frauds in large public companies. They can't say anything about frauds that were never caught or frauds that maybe were handled internally and never became public.
So we don't know if the same mechanisms work for smaller companies or for frauds that stay hidden.
Correct. And because of that focus on external detection, after internal controls presumably failed, they mostly excluded purely internal governance mechanisms from their main analysis. It's a crucial scope condition. They're studying how the outside world finds out when things go wrong internally.
Okay, so they built this incredibly detailed data set, carefully coded it, run checks. How did they then use statistics to actually test those competing theories about who blows the whistle and why? What econometric methods did they bring to bear?
So their main workhorse method was a conditional logic estimation. This is a technique that's really well suited when your outcome is a choice among several distinct categories. In this case, the choice is which of the 10 types of detectors actually revealed the fraud for a given case.
So rather than just predicting fraud detected yes/no, it predicts, was it the auditor, the employee, the media?
Precisely. And the beauty of the conditional logic here is that it allowed them to include fraud case fixed effects. Think of that as controlling for all the unique, unobservable characteristics of each specific fraud case, how hard it was to find, how complex it was, etc.
So they could compare the likelihood of different actors detecting fraud, holding the difficulty of the case constant.
Exactly. That's crucial for statistical conclusion validity when you're comparing detector types across diverse situations. It helps isolate the effect of the detector's characteristics versus the case's characteristics. And they cleverly bundled potential whistleblowers into indicator variables based on those theories we discussed: the legal view, the financial risk view, monetary rewards, career concerns.
And the access to information idea.
Yep, they had a cost of access variable too. They set it to 0 for actors like auditors and employees who have intrinsic access, and 1 for others who have to dig more. This bundling let them directly test the overall explanatory power of each theoretical lens. Very neat design.
Did they do anything to check if the results were robust, maybe sensitive to how they measured things?
Absolutely. They did several robust checks. One key thing was weighting. They ran analyses treating all frauds equally, equal-weighted, and also analyses where frauds were weighted by the size of the settlement and fines, value-weighted.
Why do that?
Well, you might worry that a couple of absolutely enormous frauds, like Enron or Sandan, we're talking billions in settlements, could dominate the results if you just average things. By value weighting, they could see if the patterns looked different for the really big impact cases. They even winterized those settlement values to prevent the absolute extremes from having too much influence. It addresses potential external validity concerns about whether the findings apply similarly to smaller versus massive frauds.
Got it. And did they use other methods for specific types of whistleblowers?
Yes, they tailored the analysis for specific groups. For auditors, they looked at turnover rates. Do auditors who blow the whistle get fired more often? They also used a conditional logic model to see if being associated with detecting a fraud helped or hurt an auditor in attracting new clients, looking specifically at changes after the Arthur Andersen collapse.
Because Andersen's collapse might have changed the incentives or perceptions around auditor whistleblowing.
Potentially, yes. For analysts and journalists, they compared career paths, promotions, demotions using logic models for analysts and statistical tests, comparing journalists who broke fraud stories to similar journalists who didn't. For employees, they used simple proportion tests and logic regressions. A key comparison was between the healthcare industry, where quid tam rewards are common, and other industries.
To isolate the effect of those monetary rewards.
Exactly. They controlled for other factors, too, like being in a regulated industry generally. This helps strengthen the internal validity, making sure it's likely the quid tam incentive itself driving differences, not something else confounded with the healthcare sector. And finally, they did a sort of difference in differences analysis comparing the pre-SOX period to the post-SOX period in their sample to see how whistleblowing patterns shifted after that major regulatory overhaul. So a whole toolkit of methods, really.
Okay, quite a sophisticated approach. So after all that rigorous data collection and econometric analysis, what did they actually find? Did the results line up with those traditional theories, or did they uncover something unexpected? What were the main headlines?
The results were pretty groundbreaking, honestly, and they definitely answered the research question. The single biggest finding, the one everyone quotes, is that it takes a village. No single type of actor dominates fraud detection. It's incredibly diverse.
Not just the auditors and the SEC, then?
Not at all. They found 6 different player types, each accounted for at least 10% of the detections in their sample. And no single group accounted for more than 17%. It's remarkably spread out.
So that immediately challenges the traditional views, right? How did those specific theories fare?
Poorly, frankly. They found very weak support for the traditional views. The legal view. The SEC only accounted for 7% of initial detections, auditors 10%. The private litigation view. Lawyers initiating detection were only 3%. The financial risk view also looked weak, equity holders just 3%. Debt holders essentially 0, absent, as they put it. Even if you generously lump in auditors, analysts, and short sellers under the finance umbrella, it only accounted for about 38% of cases.
Wow. So where was the detection coming from then?
This was the big surprise. Non-traditional players were key. Employees were the single largest group, detecting 17% of cases. Non-financial market regulators think industry-specific regulators got 13%, and the media also got 13%. These are groups often left out of standard corporate governance discussions.
Employees and the media being that high is really striking. Did it matter if it was a huge fraud? You mentioned valuating.
Yes, and that changed the picture somewhat. When they valuated by the size of settlements and fines, the media's importance shot up to 24%. Suggesting journalists get involved or their stories have more impact in the absolute biggest cases.
Interesting. And what about the traditional monitors in those huge cases?
They looked even less important. Auditors dropped to 7%, the SEC to 6%. So for the mega frauds, the traditional gatekeepers seemed even less likely to be the primary detectors.
And did the econometric analysis back up those ideas about incentives and access?
Strongly. The analysis confirmed that incentives and access matter. Detectors with potential monetary incentives were significantly more likely, about 23 percentage points more likely to blow the whistle. Career incentives also boosted the probability by about 11.5 percentage points. And crucially, those without easy access to internal information were about 15 percentage points less likely to be the detector. It supports the idea that both motivation and opportunity are critical.
That's compelling evidence for those missing factors.
Yeah.
What about the specific groups? Did they find clear incentives or maybe disincentives for auditors, employees, journalists?
They did, and the picture varies a lot. For auditors, the incentives looked weak, maybe even negative. Auditors who revealed fraud were more likely to lose that client, about 50% turnover versus maybe 15% normally, and they seemed to suffer reputational damage, making it harder to get new clients. Not exactly encouraging.
Yeah, that doesn't sound like a reward. What about analysts?
Analysts were interesting. Whistleblowing analysts weren't more likely to get promoted, but they were significantly 45% less likely to get demoted in the following 2 years. The interpretation was that it might be already successful, established analysts who blow the whistle, perhaps to protect their existing reputation and avoid sliding down the ladder.
Okay, more defensive than offensive career-wise. Journalists.
Journalists seemed to benefit. Those who broke major fraud stories were more likely to move to better jobs afterwards and rarely got demoted. This was especially true for prestigious news outlets and for those really large cases. And remember, 75% of them identified themselves by name, suggesting they felt confident about it.
So positive career incentives there. What about employees? You mentioned they were the biggest group, but the cost sounds high.
Yeah, employees faced a really tough situation, huge personal costs. 82% of those named were fired, quit under pressure, or had their jobs significantly changed for the worse. Many reported extreme hardship, with one quoted as saying something like, "If I had to do it over again, I wouldn't." Really grim.
That's heartbreaking, so why do it?
Well, two big things stood out besides just, doing the right thing. One was avoiding personal legal liability in about 35% of employee cases. That seemed to be a factor. The other was the huge potential payout from quid tam suits in relevant industries. We're talking rewards of $35 million, $70 million, and some examples they cited. That's life-changing money, even if the personal cost is immense.
A huge gamble then. And lastly, did SOX change things?
It did, but maybe not entirely as expected. Post-SOX, auditor detection jumped significantly, from 6% pre-SOX to 24% post-SOX in their sample period. The SEC also increased its share from 5% to 10%, so some intended effects there.
But what about employees? SOX had whistleblower protections.
Right, but interestingly, employee whistleblowing actually decreased slightly in their sample, from 18% pre-SOX to 13% post-SOX. This suggests that maybe the enhanced protections in SOX weren't enough to overcome the perceived costs, or didn't boost incentives as much as hoped, at least in this time frame, and for this type of large public fraud, a really important nuance.
Okay, so pulling it all together, what were the main conclusions the authors drew from this mountain of evidence? And critically, given the careful design and analysis, do those conclusions seem well warranted?
They drew two main conclusions, and I think both are very strongly supported by their data and methodology. First, fraud detection in the U.S. relies on a complex, diverse web of actors. That village idea, not just the traditional players, the data is just crystal clear that auditors, the SEC, lawyers, equity holders, they are far less central to initial detection than previously assumed.
While employees, media, industry regulators are much more important.
Exactly. That conclusion flows directly from their distribution tables like Table 2 and the econometric results in Table 3 showing weak or insignificant support for the traditional views. It's hard to argue with that pattern in their data.
Okay, that's conclusion one. What's the second?
The second is that incentives for most existing whistleblowers are pretty weak or even negative. The main exceptions are journalists covering big cases and employees who are eligible for those qui tam rewards.
And that's backed up by the detailed analysis of each group.
Absolutely. Their tables Thoth v. 7-8 break down the career and monetary consequences for auditors, analysts, journalists, employees, the negative outcomes for auditors and employees, contrasted with the positive for journalists, and the specific impact of qui tam et al. Provides compelling evidence for this conclusion.
So a natural implication then is maybe we needed better incentives, especially considering the cost employees face.
Precisely. That's the major policy implication they draw, and again, it's well supported. They strongly suggest that the role of monetary incentives should be expanded. Their key piece of evidence here is that comparison between employee whistleblowing in healthcare, where qui tam applies, and other industries. Remember, it was 41% detection by employees in healthcare versus only 14% elsewhere.
A huge difference.
Huge. And crucially, they specifically checked if this led to a flood of frivolous lawsuits in healthcare, which is the big worry people always raise about expanding bounties. They found no evidence of that in their data.
So they directly addressed the main counterargument.
They did, which makes their case for potentially extending qui tam-like rewards to other types of corporate fraud much stronger. It aligns perfectly with Hayek's idea you want to sharpen the incentives for the people who already have the information. It's about leveraging that dispersed knowledge effectively. Their conclusions seem very well grounded in their findings.
What a fascinating deep dive. It really overturns a lot of conventional wisdom about who keeps corporations honest, doesn't it? It's clear our understanding needs a pretty significant update.
Absolutely. This paper really forces you to think differently about the whole architecture of corporate governance. It's not just the board and the auditors. It's this much wider, messier, but crucial network. And for you listening, maybe consider this.
Yeah.
The authors found employees often face terrible retaliation, losing jobs, immense personal stress just for doing the right thing. It raises a really profound question. Why do so many organizations seem set up to penalize honesty rather than reward it? What does that say about corporate culture beyond just the economic incentives we've talked about?
That is a powerful thought to end on. It's not just about structures and rules, but about the underlying values and culture within firms. And it definitely points to future research, right?
Yeah.
How do we design systems that better protect and reward those employees, the ones on the ground, outside of specific laws like qui tam?
And what are the longer-term effects of SOX or maybe Dodd-Frank and other regulations that came later? Are the patterns shifting again?
So much more to explore. This deep dive really highlights how vital this kind of empirical work is for understanding corporate accountability. Well, until next time, keep digging, keep questioning, and keep learning.
Thanks for tuning into the Lion's Share podcast. If you enjoyed today's discussion, share it with a friend and join us next time for more ideas worth talking about. We'll see you next time.